We are very happy to host this event tonight, which we undertook to increase the visibility of talented investment managers. I'd like to introduce our moderator, Amanda Tepper. For many years, Amanda was a top-ranked sell-side analyst and also a director of research. And subsequently, she ran AllianceBernstein's global client portfolio management team, all of which prepared her quite well for her most recent chapter, in which she founded not one, but two companies. And both companies are dedicated to helping asset managers raise institutional assets and manage them. So AM 2020 promulgates best practices in sales and marketing, and the Chestnut Advisory Group helps asset managers implement those best practices. Please join me in welcoming our moderator, Amanda Tepper.
Thank you. Thank you very much. This is great. You're going to enjoy hearing from Rupal and Melda. I'm going to ask Rupal and Melda to just briefly introduce themselves. We're not going to review their bios. You've got all the handouts. But rather to explain, I mean, they both are very successful money managers, portfolio managers at big firms. So how did you get there? In your current roles?
I started very early in this profession of finance, and unlike many other people, I just knew I wanted to be on Wall Street. So I started working in finance at the age of 16. I learned accounting by the age of 14. I mean, I just knew what I wanted to do, so you just kind of go about it. You know, as a student, you're always running out of money, so I wanted to make some money in my young days, and I found oddball jobs. In those days they didn't call them internships, it was apprenticeship, which is really code for, you don't get paid, but you get paid like a low stipend. But anyway, it was cash flow for a teenager. And so I started working at various financial services companies, at an investment banking firm, at a foreign exchange trading desk. I mean, I sort of didn't know what I was doing, but it was sort of finance. And over the years, just during my undergraduate years, one thing led to the next, which is I just learned a lot on the job. And I have to say that, after doing that for a couple of years and getting my master's degree, I came to the US to do my master's here. And by the time I actually studied my MBA, I found it didn't teach me much because, you worked on the job, you kind of have learned on the job. And so that was a boring part of my career. But then I had this new challenge awaiting me where I was looking for a job in the United States in that Great Recession of 91, 92. Which was, I know in your books it's 2008, but not in mine. And so I didn't end up on the buy side, which is what I wanted to do. I ended up on the sell side. I didn't like it at all at the time, but I have to confess, it was the best thing that happened to me, because starting out on the sell side, I could sit and observe the different investment styles and processes of all the different buy side managers out there. I was very fortunate. I was doing emerging market equities, which back in the day in the early 90s, there was no research published on emerging markets. It was a very nascent asset class, which meant that you had to write the research, you had to pick the stocks, you had to take the managements on roadshows. I mean, you're a jack of all trades. And interestingly, my book of business was not just the classic long-only shops like Cap Guardian and Templeton and Fidelity and, the original sort of early investors in emerging markets, but also the hedge funds. And so I learned how to think about long-short very early in my career. Because my client base demanded it. I had to come up with long ideas, I had to come up with short ideas. Having done that for a couple of years, I was, again, fortunate. One of my clients liked my stock picking a lot and said, I don't think you belong to that side, why don't you come join us? And that happened to be Soros Fund Management. So my career, unusually, started out moving from the east to the west. Most people tend to do the opposite. I'm now in the long-only world, but I started out in the long-short world. The lesson that I have learned in life, don't let any opportunity go to waste. Your work can speak for itself. And certainly I've been very blessed that my clients notice my good work and then they ask me to come join them. So when I moved from Soros to Oppenheimer, they had also been a client of mine. I got a chance to sort of broaden my coverage from emerging markets to more developed markets, doing not just international equities, but doing global equities. And here's something that really helped me out, which I didn't plan for, but this is how you create opportunity out of challenges. We just coincidentally happened to have turnover on our team. So we had a departure of our Japanese equity analyst at the time. And I was, quote unquote, the emerging Asian expert, right? Because of my heritage, I guess. And someone had this wise idea that, oh, you know India, so you can cover Japan. I never spoke, I still don't speak Japanese. And, covering Japan is one of the most daunting things that you can do, I think. Well, certainly it felt that way to me. But the lesson I learned from that experience, and by the way, I did cover Japan, and it was one of the best performing contributors in our portfolio, which, amongst other things, then led on to my becoming a portfolio manager, because I know that's one of the questions that people have, how do you sort of transcend that glass ceiling? And I have to say, in my entire career, it's always been my work allowing me to leverage one opportunity after the next. And the thing that I have always tried to do, and I would suggest that to anybody in this audience, is raise your hand when there is anything that someone wants you to do, or even if they don't ask you to do it, if you know it needs to get done, do it. And you'll be amazed as to how the power of your own work and contribution. Our industry, asset management, is an industry that depends upon impact on the portfolio. It depends upon impact on our contribution to our clients' success. So if you can have that impact, doesn't matter what it is. For me, it happened to be Japan. I mean, I can't believe it. If you had asked me, to plan my career, and I'm not saying it was the only thing, but I am trying to give you some pivotal sort of examples. I didn't shirk away from that challenge that was thrown at my step. And we did well. And, things just built on from there. I left Oppenheimer Capital to join Mackay Shields, where I spent the next 10 years. It's a boutique firm, and I was the co-head. By the time I left Oppenheimer, I got the opportunity to become the head of the team. And that really taught me one big lesson, which I want to share with you. Because unlike Melda, who has many, many people reporting to her, in my entire career, I've striven very hard to not have too many people report to me. Because I want to manage... I learned early on, I want to manage money, I don't want to manage people. And the two are very different skill sets. And the thing I can tell you from my vantage point, having been on both sides of it, is when you are working for someone who has to manage money, try to not be a high maintenance individual. Because money management is high maintenance to begin with. The markets take all your energy away. And that's something that, knowing that, I've always worked at boutique firms, and I've chosen sort of, where I'm going to be more successful, playing to my strengths, not my weaknesses. Mackay Shields, after 10 years of doing extremely well there, and again, managing a 5-star ranked fund and, top decile performance, etc., multi-billion-dollar strategies, but the Great Recession happened 2008. There was a change of management, as we are all used to in our careers, and the new management team decided, hear this, okay? I have to say this, like my mini victories, right, after all these years. In the year 2009, they made this brilliant decision that they wanted to focus on fixed income and give up managing equities. So they decided to downsize the equities team, despite the fact that we had terrific performance. So I knew I had to find a new home, and that's how I ended up at Ariel, because we have a very similar investment philosophy. I'm known to be a contrarian to the extent that you guys have Googled me. You know that. It's my second name. And we do things very counterintuitively. Having come at Ariel, I would tell you that I'm looking to build out my team. And if anybody wants to raise your hand and send me your resumes, I'm open for business. And with that, I yield to Melda.
I'm originally from Turkey, and I came here for my graduate studies. And but how I decided, or how I knew I wanted to be in finance, was partly because my father was a CFO and became a CEO. My mom was in the banking industry, so finance was something in the mix for me from the beginning. And my cousin, who was doing PhD in finance, when I start talking about her, why I like finance, or in terms of like the things that was very familiar to me, she said, you can choose the path of being in the corporate side of it, or you can do the investment side of thing and have more access to all those things, happening in different industries. So that was kind of the introduction to me to the investment side of things. And I always loved numbers, but I didn't want to be engineer, just because engineer to me is so well defined, what you do and what you become an expert of. So that's how I ended up being more on the quantitative side of the finance. So I came here, and my master was concentrated in quantitative finance derivatives. And then one day at the university, one of my professors gave me a post-it and said, go to this address and talk to this person. I said, okay. And I figured it was something to do with the job, but he didn't tell me the whole details. But long story short, that was my start of looking for a job or finding a job in U.S. I didn't think, I was actually married, my husband is Turkish. I didn't think that I would stay in U.S. this long, but I mean, I don't know what I was thinking. This is where it happened. So of course I had great opportunities. But I think to me I was laughing when you said, raise your hand. My husband, like maybe a week ago, reminded me, apparently I came home one day and I told him, what happens if things finish? Like there's no project or nothing to do. What am I going to do? And he was looking at me. He's like, you're crazy. It never ends. Well, why are you so nervous? Because that was the thing. I would raise my hand, and there were times I would raise my hand and go to my office. I'm like, oh my God, what did I do? Like, I have no idea what's going to happen. But that got me a lot of opportunities to be out there in my organization. I stayed with Columbia Threadneedle from the beginning. I've been there for 17 years. And again, I started quantitative as an analyst, and then I moved to this role, which we call investment oversight, and we have a process we call 5P, which is a job that I created for myself. And there's still no equivalent of it, I don't think. I was a little bit worried if I had to change jobs, how am I going to explain this? But think it as Six Sigma in investments. So my team look at all of our strategies across the asset classes, and it is define, verify, monitor, and then improve. I had this opportunity of working in every asset class, best of class, asset RPMs, internal PMs, and I was in a position and had the luxury to be in a position to work with them very closely, kind of get into their brains and understand what they are trying to do and verify, most of the time quantitatively, which, believe me, I had very interesting conversations with very old school PMs about that. I can share. One of my introduction was, I don't believe in what you do. I don't believe in risk. I don't believe in numbers. Just kind of saying go away in a very, kind way. But, and then that gave me, and the thinking for me was at that time when I created that job for me, because my boss moved to a CIO role within the organization, and he started it in the Equities, which I was part of it from the beginning, but made it more for all asset classes. My thinking was, there is no other job that would give me that type of access unless I'm on the sell side, which I wouldn't do it at the time. And it happened. I think I was much more well-rounded at the end of that journey in the sense of understanding all the challenges and the opportunities. And 2.5 years ago, I was given the opportunity to head up our equity portfolio management teams. Again, it was a very easy transition for me on the investment side, understanding our strategies, but managing people and partnering with our other parts of the organization is a journey that I'm on, and I'm enjoying it, but that's another learning for me now.
What we've got here are two equity portfolio managers. Melda is primarily quantitative. Yes, Melda is primarily quantitative. Rupal is primarily fundamental and value. Rupal is doing international and global portfolios. Melda is doing her team under her that she's looking at runs 24 equity strategies across all the style boxes, and she also co-manages a few funds. Also, their organizations are slightly different. So can you just talk for a minute about each of you, and Melda, you start this time, your team size, your client base, and kind of looking at it from a business standpoint, because when you are a portfolio manager in our industry, even if, of course, what you love is running money, and of course that's all you want to do every day, but you are part of management. You have to meet with clients. You have to explain what you're doing. You have to manage a team. It's a leadership role. So we're going to get to all the fun capital market stuff. We're saving that in a minute. But just from a business standpoint, can you just explain a little about how it's organized and how that plays into what you do every day?
Yeah, I'm at the end of the spectrum, being part of a big organization. We, across the globe, manage $500 billion, and in all the asset classes that you can imagine. Again, my team is managing global, regional, and domestic money, and in total of 24 strategies. I have 80 people reporting up to me. And our structure is our portfolio management teams are separate from research. We have centralized research reporting up to another gentleman, Tom West, and I'm in charge of the portfolio management teams. I really, to the point that you're making, that it is about the markets. We love to manage money, but I'm also very much passionate about the fact that we're a very people-driven business. Although it is driven a lot about with the information and the numbers, at the end of the day, people are making decisions. And that dynamic to me is, as a leader and being in my position, gives a lot of motivation to actually reach out to my teams and work with them. I am in the budget period. That part I hate, I don't like, I'm not gonna lie there. And there are definitely challenges of being a part of bigger organization, but there are opportunities too. I mean, there are unbelievable resources for my team, both personal development or, career development side, which gets me excited because again, I find it, again, the market is crazy itself and you look at it and every day there's a lot of things happening out of your control because you're there, but you're not there really. You're kind of reacting or being proactive to things that you cannot manage. This is what I can manage. These are my people. These are the outcomes for our clients. So from that point of view, I'm very excited to be where I am. We are a mix of retail and institutional book of business. I think there are a lot of, we're going to probably talk about it, a lot of changes happening in our industry. They are very secular, and it's going to end up being very different in the 5 years, in my mind, what's happening. Again, I think what keeps us going is we see the change as an opportunity instead of a challenge or like a showstopper. So I'm excited, but there are going to be a lot of changes. And to me, the most important change is going to happen more on the retail side with how we approach the clients. And we'll talk about it. I think it will fall under more active, passive discussion. But that's where I think from a business point of view, I believe in the people who are making decisions needs to be confident and resourced and supported. That's my job as a leader, on top of what I love about the markets.
So I work at Ariel Investments, run the New York office for my Chicago headquartered parent. And we are a boutique firm and employee owned. And we very much invest alongside our clients. So the assets under management are significantly smaller than, of course, my peer over here, about $10 billion. But our mission in life is to make sure that we generate superior alpha, which is what we are paid to do. One of the things that I think is really important when you think about the business of investing, which you're correct, it is a business, is to always remind yourself, and I think the CFA Institute does a very good job of that for us, and we should all feel very proud, that it reminds us of constantly to make sure that you put the profession ahead of the business. And if you do that, actually the business will follow anyway. It's when you stop doing that that the business stops happening. So I think the biggest thing I would say to this audience is that the two are linked, but always remember what comes first and what follows. The second thing I would say is that many organizations have a choice to make in the investment management world. And I know there are many stripes that people sort of ascribe to them. They're quant, they're qualitative, they're bottom up, they're top down, they're active, they're passive, whatever. But I would observe that the attribute that you want to look for if you're looking to be part of a successful, sustainable, and I say sustainable in sort of a longevity point of view, asset management company, is that look for a company that is led by investment excellence and led by investment people, not by marketing or distribution. This is a very important distinction to make because asset gathering can often come at the expense of asset management. And so I think there are certain principles that you always keep in mind in trying to make sure that you do right by the profession as well as right by the business. So that's my only observation about what is important for the audience to keep in mind as they look for either building a successful organization of their own or teaming up with one, as I have, to never confuse the two.
For an asset manager nerd like me, this is heaven. This is great. We were talking before about the people, and we both touched on that. So whether they report to you or you get someone else to do all the budgeting and the reporting, you can't do it by yourself. You've got to have a team. How do you manage? How is that the same or different from how you've been managed over the years, and what are the attributes that you look for someone to be on your team?
I don't define it necessarily with numbers and the reporting lines. In my mind, why I think we are where we are is also that ownership, regardless of somebody is defining it for you, either through reporting lines or any other kind of structural, framework. I'll tell you my first one-on-one with my direct reports, which were my, again, colleagues for a long time, and I worked with them in a different role, so I came into this role. It wasn't even a peer thing, it was more of I was in a support role. So the only thing that I told them as a starting of the conversation, I said, I'm here to facilitate, communicate, and coordinate for you. I'm not going to come in and tell you what to do because I know what you do. You are best in what you do. But my job is that I will resource you and I will be the person who is making it working for you so you continue to do what you do. We are a different breed. We have to accept that, as the PMs and the analysts. What I mean by that is the fact that our thought process is very different. And that's what I am actually discovering working with the other parts of the organization. And I find why sometimes as the investment teams we come across in an organization like mine as divas or however you want to call it. Or the reason is a lot of times our interaction is about getting information, validating the information, and making a decision. And we do it on a regular basis. So for us, any conversation is not, many times in my mind, is about personal, interaction about that information and where we are going to go with that. That's why the management style I have is similar. Like, I am aware of my audience. I am aware of the fact why they are really passionate about what they do. I encourage them have the confidence and conviction in what they do. That's why I love the process we have to validate what they do is actually working, because once we validate that, I want them to go and do it as much as they can. So to me I am the buffer between them and anything around them that would distract in the organization. I even our CIO, I sometimes put him at the arm length saying, no, you're not talking to the PMs right now, because he's either, excited, upset, whatever that emotion is, but I don't want anybody to mess up with their thinking, That's how I think about my management. And I think it's very specific about the fact that I am working with portfolio managers. I am working with people who are actually on the line. Their names are there. A lot of people don't understand it. When you look at a fund, they see your name. It's your reputation out there. I think that's why my management style is very hands-off, very transparent, very regular. I'm very religious about my one-on-ones, for instance. I never, ever cancel them. They can if something is happening, but I don't. I either reschedule if it is really tight, because I need that connection on an ongoing basis. So I'm aware of where the problems are, and I need to stop them before they become real problems. So that's how I see management.
And Rupal, you're working with analysts. We're all recovering analysts, right? All three of us. That's where it always starts. What makes a great analyst? How do you ideally want your team? How does it work with you?
So I think, for better or for worse, I'm still an analyst, and I'll always be an analyst. I think you don't become a good portfolio manager without having the respect of your analysts, or at least that's how I see it. And I sit in their shoes. They know that. So I think my role is somewhat of a player coach from that standpoint, and I take both roles very seriously. And when we have an investment debate, there is no hierarchy in that room, because in the investment management organizations, the best ideas must compete, not people competing. And so, yes, I have the role of portfolio manager and CIO, and but that's, as an analyst, and you asked the question, what do I look for? It's what I look for in myself. And how did I become better myself? I hope you don't take this the wrong way when I say this, but I think analysts give themselves the title of analysts without being analytical. And that is the biggest issue I have with a lot of people. They don't analyze.
They report.
They regurgitate, they collect information, they collate information, they don't connect it. That is not analysis. So if you want to be an analyst, be an analyst. That's all I'm going to say.
There you go. There are many, 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 many studies out there showing that women portfolio managers deliver superior investment performance. There are also a lot of studies, and I can just say my own personal experience, shows that women in general are pretty reticent to self-promote. So here's a great platform for each of you. Each of you has generated really strong performance. So Rupal, let's start with you. Please give us some details of your performance track record and how do you do what you do?
The fund I manage, the Ariel International Equity Fund, has 5 stars, and the Global Equity Fund has 4 stars. And throughout my career, often I've had these kinds of stars. But it's really, the important thing to note is that performance is an outcome. You can't chase performance, it comes to you. And the way you make performance come to you is by having an investment process that delivers that outcome. It's sort of like you can't start out thinking, you're just going to bake a cake and not first think about what are the ingredients, what is the recipe, what's the process that's going to get you there. Once you do all that, the cake sort of makes itself. And I think that's something that I really focus on. I often think of myself, and I often tell my clients this, yes, I have the title of a portfolio manager, but I really am good at is I'm a good process manager. And I handcrafted my investment process, and I designed it, and so I'm the vanguard of it, and I implement it. So I think that's sort of what really explains the secret of my investment success is my investment process. I think the other thing that is very important, I don't know about whether I'm successful because I'm a woman, because I've never been a man, but I would say that, and I don't know if this is because of my gender or because of my roots, which is I started out this investment career on the long-short side, and I told you I had a lot of long-short clients. So I'm wired to think of both sides of the trade, right? And women tend to think both sides of an issue. I don't know if one led to the other or reinforces the other, but I do think that's really, really important to understand anything, right? Whether it's a human being, whether it's a political issue, whether it's an investment debate, understand both sides of the case and let both sides make that case. Think about anything that you see in another profession, like, the most important decisions like passing judgment on someone in a court system, in a justice system. You give a fair hearing. You hear all sides before you come to any conclusion. And I'm not saying it always leads to the right one, but it does lead to a fairer one. And I think that's kind of what I try to do in the structure that I have.
What you were saying, Rupal, on looking at both sides, a lot of these studies show that the outperformance of women portfolio managers is often on the risk side. They don't take on as much risk. They don't move things around because they need to move things around. So that's
certainly true for my track.
Yes.
You're absolutely right.
So that's anecdotal support to what some studies have shown. Anyway, please tell us your side.
Sure. My longest track record is with a domestic large cap core product that I managed for 5 years. A fundamental stock picking, process and best ideas portfolio. What has been success for me is the fact that, again, I played to my strength, meaning that I didn't really try to reinvent the wheel, knowing that I've been in that position before, looking at all of our strategies. I know our analysts and all that stuff, and then I have the quantitative background. This portfolio I built, to your point, is about the process and about the discipline of the process, and I think it speaks to the fact that I think women stays with the discipline much easier than men, in the sense of it's really, we can focus on something and we can say, this is what I want to do, and it's, I think, harder to kind of harder for us to change the course. But again, I played to my strength, and I stayed disciplined with it, and it's been successful so far. But I think, to your point, what I observed across the board, looking at the good successful strategies, regardless of the gender, still the biggest commonality in my mind is the discipline with the process. If the process is proven, the most important thing is there are going to be times the monitors, the markets will tell you you're turning stupid, which is not true, but it is human nature. You can lose your confidence and the conviction in what you do. That's where it makes a huge difference. If you stick to it, and if you remember, to the point that it is about your client's outcome and the longer-term outcome, it's not that because there's a headline in Bloomberg and all of your theses are out of the door. It's not the case. If you can stick to that type of focus, I think a lot of PMs are actually successful regardless of gender.
Great, because both of you manage equity portfolios actively, and that is an asset class that has seen increasing outflows towards passive strategies with much lower fees. So I'd like to hear each of you a little bit on the value of active equity management, particularly large. You're both in large cap, so.
I think biggest threat right now is to large cap domestic equity, because S&P 500 or whatever your passive is out there. And in my mind, I put the burden on us as the active managers, where I say we earn the easy money. And when I say easy money, it's not because the job we do was easy or easier. It is about the fact that we had the luxury of not explaining ourselves because there was no competition for a long time. Now there is the competition of the cheap alternative of accessing the market. But to me, is active in itself is being different than the market. And we never defined or even ask our clients what it means to them. I think that's the secular change happening, that everybody's more focusing on now the client outcomes, the solutions, what really they are trying to do. I read it before, and I'm reading again, the innovator solution. We I would say, produce what we produce, meaning that there were a lot of peer groups, this and that, and trying to make a differentiating factor around what we produced before and adding on to these different metrics. It's not about that. I'm going to sit with somebody and ask, what is your life goal and what are you trying to accomplish? With that, active, I think, still has a lot of role. I mean, if you're in a life cycle of getting close to retirement, there's no point of being S&P 500. You can get a better return in equities. So that's the type of things we are going to, I think differently. So I see it as an opportunity, again, going after what we do best is, if we define it best and ask our clients what they want to do, I think we'll be fine.
I guess there are lots of people in the passive world or allocators who are allocating to passive. I just have one thing to say about it, which is bring it on. I think I'll give you this example of, again, a one-sided view of things, which is active and passive are constantly compared against one side of the equation, which is returns. What it's not compared on is risk. And as Amanda just pointed out, and I don't know if you know, but the Morningstar rankings, 5 stars or etc., they are allocated not to the funds that outperform the most. They're not. You can have better performance and still not get those stars. The stars are allocated to those who have higher returns per unit of risk taken. So it is a risk-adjusted return measure. The benchmarks are not measured on risk-adjusted return. And I will just give you one observation as to why I think this trend towards passive is really rear-view mirror of the last 20, 30 years, which is a generation has experienced a bull market. And passive is a mirror and reflection and symptom of a bull market. Try doing passive in Japan. Amen.
Wait, keep the microphone. Keep the microphone. Okay, that's actually a depressing thought.
It isn't. I'm sorry if I just want to make sure you understand.
No, passive in Japan is a depressing thought.
Oh, good.
Yes.
Because
that's
active in Japan was amazing. Amazing. because you could cherry pick your way into identifying the phoenixes that rose from the ashes. And anybody who thinks that Japan did not have great companies, did not have great track records, did not have great success on the global arena, you all buy their products. I mean, case closed. Japan is a force to reckon with. You would not have seen that doing it through passive. So thank you.
Right. Very interesting, and we could talk about that for a long time. So you focus on fundamental research and long-term valuation, but what are some of the contrarian investments in your portfolio today?
All of them, but
that you want to talk about here?
I want to help you understand how a contrarian thinks. It's harder than you might imagine. But it's more rewarding than you might imagine. So allow me a thought experiment with this crowd. Everybody complains about, there's no opportunities out there, all markets have gone up, everything is in favor, can't get returns. I mean, there's just complaints all around. And yet we as active managers are supposed to find opportunity in any market, right? And there is one part of the world that I think there are some phenomenal companies, and actually we're quite exposed to them. Obviously, I put my money where my mouth is. I'm going to just get a quick sense from you guys. If you had to name one country in the world that you think is the least liked, what would it be in the developed markets? So I'm not talking some small, tiny frontier market. I'm talking like a big country that you could put money to work, and yet it's the least favorite market of all to anybody you talk to. Developed market. Japan comes to mind, yes. But I already told you what a great investment opportunity that was. So imagine a non-Japan, like Japan, UK, what else? Australia, Germany, Spain, okay. Obviously, you all don't think like contrarians because you didn't name the country that I was thinking of. France. People think the French companies, they don't have capitalist regime, they don't have good corporate governance, they don't care about making money. It's sort of a country with high costs, nothing to show for itself. So I'll give you a list of 5 amazing companies that used to be at amazing valuations, not all of them are today, but ones that I've made money with. L'Oreal. Talk to Procter & Gamble and they will tell you L'Oreal gives them a run for their money. Michelin. Talk to Goodyear Tires, talk to Cooper, talk to Bridgestone. They will tell you Michelin gives them a run for their money. Michelin is a French company. There's another company called Gemalto, which you may not be familiar with, but it's a company that does all the passports, the biometric screening, all the security stuff that you're having at government offices. It's all done by this company. You look at Airbus, which is the airplane that I'm sure many of us fly in. Boeing will tell you they give them a run for their money. And this is a very difficult industry to compete in, okay? Imagine a French company taking on a company like Procter & Gamble on their home turf of America and succeeding. P&G's home market, they took them on, and today the shampoo brands that they have, the personal care brands that they have, L'Oreal, is a name to reckon with. Oil of Olay is not the name to reckon with. And I'm just giving you these examples of how people just trash companies, not recognizing that there are so many success stories that happen to be French, but nobody goes looking for them because who the hell goes looking in France, right? And there's Essilor. Many of us wear glasses, and especially after a certain age, you wear those, bifocals, the Verilux lenses made by a French company. The CAD-CAM systems that design all these 3D images, is Dassault Systems. The French have some amazing technologies, and we just don't hear about them. And by the way, a tire is a high-tech product. Do you know you pay more for a tire than you pay for a laptop? You know that, right? Of course. There's a reason.
Thank you. Melda, your firm, you're looking at it from a different point of view. So macro, you're across all the different asset classes. And your firm has long had a macro view of lower for longer. So can you talk a little bit about that? How's that playing out in the markets and across your portfolios, and where do you see that going, and any themes you want to address?
It was after the financial crisis we actually made our outlook was, we called it square root of recovery, meaning that it's going to be a big rebound, but after that it's going to be very steady and slow growth. And our thinking was around the fact that there were secular trends around the demographics and where we are starting the cycle in terms of the housing market, all that stuff in the U.S., and then globally there were, reasons again that we thought the growth will be slow. So to us, during this recovery, it wasn't surprising that we were challenged with what we had. I think nobody, and including us, expected the monetary policy being this long and this, impactful. I think our CIO had this analogy saying that, we understand if you're in a room and the door is closed and the fire starts, the first reaction would be you put water on it. That was the first QE, right? That's very meaningful. But if the fire is out to the extent that you can get out of the room, you don't put the water back on the fire or whatever is left on the fire, right? So I think from our point of view, one of the things that we tried to be prepared and was not easy, but done a good job, was the fact that we were expecting as stock pickers, and I totally hear the opportunities around the globe, and our international, regional, funds found the same type of opportunities at the stock level. But on the U.S., given all these thematic, investing through the passive, we were expecting, again, we learned through the experience more and more, but the high correlations was very challenging. So our theme is still stick to our, knitting in terms of looking at the stocks and try to be very much focusing on the fundamentals and focus on the longer term thesis and deal with this whole volatility, which we experienced this year too. So for us, the theme is, again, not to go with all these headlines around, everything is expensive. In the U.S., you can still find stocks that are not expensive compared to what they can, have as the earnings opportunity. But we are more challenged domestically in terms of how those things are playing in the short term. So our theme is to stay with the portfolio construction, stay very true to what we do is, look at the companies and look at the opportunities and use the volatility to our advantage at the entry point or exit point, so that we can actually continue to implement our long-term thesis. But I would say we are worried about certain sectors like everybody else because of the yield chase. But we still think there are companies out there we can invest in and make money.
Great. I think we have time for some questions.
I was a portfolio manager for 10 years. And without a doubt, the hardest thing to do is the sell discipline. So I would like your feedback on how is your sell discipline? Is it valuation? And how do you know when a thesis is broken and it's not just the stock reacting to some headline risk?
So we don't think of valuations. We look at value spreads and we do intrinsic values and discounted cash flow analyses. But what we do differently in our process is that we run scenarios. And in the real world, things can go from worst case to best case. And so I would say that, generally speaking, the sell discipline is, if a company is pricing its best case scenario, there's no point in owning it because the risk is only to the downside. So I think that's just one test. The other test, of course, is if your thesis is broken or undermined, as you described. And that, again, is just being a good analyst. You call it out as you see it. So I think there's no substitute for that. I think this is a profession that keeps you honest. Either you can keep yourself honest or the market will, and you just choose yourself to be kept honest yourself.
For us, depends on the strategy, but I would say in many cases the best strategies with best self-discipline are the ones they have actually the bench warmers, meaning that your thesis is broken or getting a little bit rich or getting to the price target, whatever is happening in that type of journey. I find if people have other ideas, they've been looking at getting more comfortable, it's an easier decision for them because they already start thinking about, something else. And if that is comparing in terms of risk and return better, they can do a better, easier decision. I also think in our structure, separating research from PM teams helps a lot because the research team is looking at it independently. And if they start saying this is a sell signal in their own work, and the PM sticks to it. And PM is doing a lot of trade-off within the portfolio, but having that independent source also giving them, not because they go to and ask them to make the analysis, they do that analysis independently and as a trade-off, that's also helping in our structure. And on top of that, we have quantitative portfolios and quantitative models. And if stock starts getting into the quantitative model to sell, it is an interesting conversation with a fundamental, research analyst or a PM. And again, it goes back to the alternative and a trade-off within the benchmarkers.
So when you think about portfolio construction, how do you go about determining the amount of securities that you own? Is it based on conviction?
We use risk models, and our PMs are compensated relative to benchmark and peer group together. So they need to beat the benchmark to be able to get their full upside. Again, the reality is we can beat all the peer groups, but the benchmark is becoming the real competitor for us, especially in the domestic world. So we are very much, arm the PMs with the tools that they can work with, and for risk budgeting. We don't say risk management because we need to take risk. What we aim for is you take the risk where you think the return is. So for us, it is a real, tool set that they can literally go. We use BARA as the risk model, and they can look at their positioning with conviction and how much they contribute, to the portfolio risk or relative risk. Not everybody is using it the same extent, meaning that I have power users, they would do what if analysis, even if they have one trade, just to make sure. And I have others checking, once in a while. But what I found, the example I gave you, I met this PM. At the very first time that I met him, I talked to him about my role as investment oversight, and I mentioned about the risk portfolio, the risk models, and he said, I don't believe in it. But when I put through that process, his portfolio was actually very balanced. So to me is keeping the portfolio as diversified as possible doesn't mean you need to look at the risk model. It's more about the thinking as a portfolio manager and making sure that and keeping yourself honest that you're looking at all the opportunities that not owning the same thing. Because that's where I get the difference between an analyst and a PM is the fact that it's not about the stock, it's about the group of stocks as a portfolio. But conviction and risk can be very, very interesting contrasts when you use some of these tools, but I'm not saying everybody use it.
Rupal, how do you build your portfolios?
With conviction.
Yeah, there you go. Oh, come on. All right. There's a big issue around explaining what your process is, as you said earlier, and sticking to your process. So whatever that is, you have to stick to. So I'm sure you set out parameters, and that's how you construct the product around that. So, but conviction should drive it ultimately, right?
Yeah, thank you for answering the question.
Well, I saw a hand over there before.
So earlier you mentioned analysts and that they should analyze. So 2 questions. Do you think it's a generational millennial issue? And the other question, are you seeing female analysts come into your organizations?
I welcome anybody, millennials, female, male. I think it's just a different profession. I think people don't realize in most other professions being correct is good enough, not in our profession. If you are correct, but everybody else got there before you, that correct view is already priced into the stock. So it's of no use to be correct. And I think a lot of people keep using that benchmark because that's how we lead our lives. I got the answer right. I got this right. So if you think Apple is going to report $10 of earnings and Apple reports $10 of earnings, but everybody else thought Apple was going to report $10 of earnings, you are correct. But so what? And I think that's the mistake people make in passing judgment about whether they're being analytical or simply recursive. So markets don't reward that kind of research.
Are you seeing more or less women coming in? That was the other part of the question.
I don't know. I'm too small a boutique firm to, I welcome anybody, but I will say that in most investment meetings that I go to, I find myself very much in the minority. And I, not just as a portfolio manager, as I said, I'm an analyst. I think that women analysts tend to overexpress in more industry coverage, which seems to somehow skew towards more women analysts like retailing or consumer, as opposed to the more hardcore analytical ones like technology or telecommunications. And I'm just randomly sort of contrasting examples here. So I think, look, I have covered every industry in my life. I've covered telecoms, and I've covered insurance, and I've covered technology, and I've covered retail. And, I think everything is fair game. I do feel that industry coverage is becoming more specialized, and I think therefore domain expertise is a prerequisite. Now, whether a man has it or a woman has it, I really don't care. I don't see any reason why women should not succeed in this profession, if that's really what you're asking. I don't see any handicap, any bottleneck, any default reason or explanation. I do believe that they may not believe in themselves enough. I don't know. I always did. I didn't encounter that. As I told you, I always raise my hand. So I think I would just tell women, don't doubt yourself. You can do it. You've done more of this than you realize. You just have not had the opportunity to prove yourself. So avail of any opportunity that comes your way, as I said. But make sure that you can demonstrate investment excellence. Your work has to speak for itself. So don't just send a resume, send an investment report that you've written. Express your work, not just your degrees. And I think the higher up you go in your career and the further along you go up the food chain, your degrees become less relevant. Sorry, I know I'm speaking at the CFA Institute, but...
Assuming you have a CFA.
Yeah. And I sadly don't, but I did also say that my MBA didn't prove that useful, so I learned on the job. The further up the food chain, the higher up you go, your work has to speak for itself.
I agree. It's not, I think, generational issue. It is about what your kind of output needs to be and your understanding of that. And I agree with the fact that a lot of people are gathering information and reporting back that information, but that doesn't mean for a portfolio management decision it's relevant. And the assumptions that you put in, modeling is great and you need to understand how the mechanics is working, but it's all about the assumptions. Again, to your point, what it means from your point of view, all those things, and you need to communicate. And you need to reflect conviction in your thesis to a portfolio manager. About women, we have more women analysts than PMs, but I think I think the reason is with the PM jobs, it's the track record, and it's kind of a vicious circle. If you're not a PM and if there aren't many PMs with the track record as women, you cannot hire them in many cases. So we are focusing on getting them in early and make sure that they are named and get the track record going. So, but being analytical doesn't mean that you turn it into an insight and an investment decision.
How have you handled benchmarking as well as taking active bets where you have conviction? And do you think that benchmarking has been a hindrance, or do you think it's good in terms of being a guidepost?
To me, its benchmark is giving your client or the people who are going to compare you to something, an understanding of what the risk-return characteristics are, not necessarily what you own. It doesn't mean that you need to own what is in the index or anything like that. But in my mind, again, there are a lot of portfolio managers, you tell them what the benchmark and they go and do what they do. But what is happening is, again, going back to the clients and explaining your process and explaining the active bets you are taking or your ongoing permanent bets in the portfolio relative to the market, then you can use the benchmark. It doesn't really use, in my case with the PMs, to limit their opportunity set or to create a framework for them. But I don't know, I can't go without an email coming from the sell side about quantamental right now, or the factors, or the old things. That's relative to something, and that's benchmark, so you need to understand that. But it is not defined as your opportunity set, investment opportunity set for our client. I don't know if you think differently about benchmarking your process. She's gonna say, I don't look at the benchmark. No. I know the look. She's like, what are you talking about? I know.
This is my belief system. I'm an equity manager. And if you invest in equities for capital appreciation, not for relative appreciation, but for absolute appreciation. It is the absolute return that's going to pay the bills. It's the absolute return that's going to allow you to live off your retirement savings. And so I've always had in my mind the goal of absolute returns, which I've delivered. So many of my clients actually say that I've delivered hedge fund-like returns without charging hedge fund-like fees, which I need to talk to my marketing people about. But I think benchmarks are useful for third parties to evaluate you objectively, but that does not necessarily mean that you manage to them or you're driven by them. And I think that's sort of the distinction I would make. You do the research, you invest to what the research is telling you to invest in, and the benchmark will take care of itself.
You mentioned a couple times giving investments kind of like a fair trial. How do you fight confirmation bias?
My apologies. When I said conviction, I didn't mean conviction, i.e., whatever I like to own. I meant conviction in the risk reward of that investment opportunity. So ultimately, the ideas compete on risk reward. And we have conviction in our assessment of that risk reward. So I just want to be clear as to what I mean by conviction. I think you try to avoid the confirmation bias in everything that you do. It starts with the research, not just in the portfolio construction. And the way we avoid that is first by being conscious of it. In every investment debate, we have a pre-assigned devil's advocate, which prevents you from getting locked into a point of view. You have to consider multiple points of view. The other thing we look to do is we actually are not looking to select ideas, which is what I think a lot of people try to do. We are looking to eliminate them. And that, from the get-go, eliminates the confirmation bias. So I think a lot of things that we do are very different. It's sort of hard to explain all of them. But I hope that by talking about how we are counterintuitive, how we are contrarian, you can just infer that a lot of things that we do are very different than the conventional screening processes, the conventional research practices, the conventional portfolio construction, again, the conventional anything, frankly, that you typically hear in an investment process. And I think I mentioned to you that I was fortunate enough that I could design my own investment process. I had a clean slate. So I'm able to incorporate all these things. It is not a legacy that I have to work around or shoehorn my opportunity set into. It's a process that actually enhances, the opportunity set out there. So I think every person has to find that for themselves. You want to make sure that you're in the organization that is a kind of culture that I described. You have skin in the game. Remember, my own money is invested in my strategies. Nothing gets better risk management than that, and return management than that, right? Which is exactly what clients want. So I think you can go about doing things in a lot of sequentious ways, use Barra, use third parties, use a risk manager, use a compliance manager, you can have 10,000 different ways of overseeing something and multiple ways of reporting something. But the bottom line is, if you have your own money invested in it, if you are aligned with your corporation, as I am, because as I mentioned, it's employee owned, I think there's a lot to be said for that. I think a lot of these things just sort of disappear to the wayside when you have the right incentives at work.
Thank you both, and I'd like to pass it over to Brian.
Tonight's conversation was just that. It was very insightful. I think anyone here would agree. It cuts across gender, cuts across age. I found it extremely rewarding, and so thank you to all of our panelists and Amanda for leading it.